Sit across from an aggressive life insurance broker, and they will pitch you a policy that promises to handle every aspect of your financial future. But run those projections through a 30-year spreadsheet, and the marketing rhetoric shreds under the weight of the math. The pitch usually centers on whole life insurance. Brokers emphasize a guaranteed cash value, tax-free loans, and a forced savings account. They sell it as a private bank for the individual. But beneath that elite framing, consumers often harbor a nagging suspicion. They are locking themselves into an opaque product with a lifelong, expensive premium. We are going to audit those premiums. By stripping away the marketing and relying strictly on cold math, we can track exactly where every single dollar actually goes over a 30-year timeline. Today, we are auditing whether whole life actually functions as a reliable wealth engine or an incredibly expensive trap. Achieving financial clarity requires a principle called the Great Unbundling. This is the practice of separating distinct financial utilities into their own dedicated vehicles, rather than mixing them together. First, you have pure mortality risk. This is a temporary vulnerability, the years when you have young dependents, a mortgage, and not enough savings. It requires cheap, temporary protection. Second, you have wealth accumulation. Building wealth is a decades-long endeavor that requires transparency, high yield, and extreme liquidity. The insurance industry deliberately combines these two opposing forces, temporary protection and long-term saving, into a single whole life product. They do this to justify charging thousands of dollars in extra premiums every year. Bundling these goals leaves the consumer with neither optimal insurance nor an optimal investment. Let's apply this to a specific case study. Meet Sarah, a 32-year-old non-smoker who needs exactly $1 million in coverage to protect her family's future. This matrix compares her two quotes. Option A, the whole life bundle, costs $9,430 a year. Option B, a 20-year term policy for the exact same $1 million payout, costs $416 a year. That is a staggering difference of $9,014 annually. It is tempting to assume the extra money routes into a savings account, but watch what happens to that first year of payments. A massive slice of that pie breaks away before it works for Sarah. That slice is the year one commission cliff. Historically, almost the entirety of the first year's premium on a whole life policy goes straight into the selling agent's pocket. After year one, administrative fees continue to eat into the returns. Because of this drag, the internal rate of return on that cash value frequently barely outpaces basic inflation. The high premium doesn't buy better mortality projection. It funds the industry's marketing and commission structures. Now we pivot to the unbundled alternative. We track what happens if Sarah buys the $416 term policy and intentionally captures that $9,014 difference every single year. This graph maps the deployment of that cash into a basic S&P 500 ETF inside a tax-advantaged account. An ETF, or exchange-traded fund, is a low-fee basket of securities that tracks an entire market index. Over 20 years, the math takes over. By consistently investing the difference without the drag of insurance administrative fees, Sarah builds a liquid asset pool of roughly $394,000. Year 21 presents a transition point. Her term policy expires, and that $1 million death benefit vanishes. However, Sarah's situation has changed. Her mortgage is largely paid down, her kids have graduated, and she has nearly $400,000 in liquid wealth. She is now self-insured. Term insurance provides the 2 decades of time necessary to build an unshakable financial foundation without the high-cost drag of a bundled policy. To finalize the math, we have to look at the ultimate mechanical test of the whole life product. What happens when a policyholder dies? The insurance company reliably executes the contract. They pay out the guaranteed $1 million death benefit to the beneficiaries, exactly as promised. But this diagram illustrates a quiet industry secret. When that payout is triggered, the built-up cash value, the money the policyholder sacrificed to liquidity to accumulate, is almost never passed on to the family. Instead, the insurance company absorbs that cash value account. They use those savings to offset their own internal cost of paying out the death benefit. Because you cannot pass on both the death benefit and the cash value, the narrative of whole life as a primary investment strategy sails the test of logic. Whole life functions as a hyper-specialized financial tool that is frequently marketed to the wrong demographic. This tree outlines who benefits. First, individuals with net worths exceeding the $13.6 million estate tax exemption. Second, parents funding irrevocable trusts for special needs dependents. Third, complex corporate key man structuring. Otherwise, you join the 95% who should buy term. Whole life is an estate planning tool for the wealthiest 5%. It is not an efficient wealth builder for the 95%. If you fall into that 95%, here is the 3-step process to implement the unbundled strategy immediately. Step 1. Calculate your strict coverage need. Multiply your gross income by 10 to 12 and add in any outstanding mortgage debt or expected college expenses. Step 2. Shop the aggregator platforms. Pull 20-year term quotes exclusively from carriers with an AM Best rating of A or higher. AM Best is an independent agency that rates the financial stability of insurance companies. Step 3. Automate the difference. Set up an automatic monthly transfer to route the exact premium savings from your term policy into a low-fee index fund. This final step is essential. The unbundled strategy fails if you buy term insurance and then spend the difference rather than investing it. Keep your pure mortality risk cheap and your investments transparent. By separating the two, you allow cold math to build your generational wealth.